in 2016, you wrote the great book, A New Case for Gold.
Yep.
And this is almost 10 years ago now, right?
Yeah.
So you were way ahead of this issue. And now gold's at almost an all-time high. You've seen the reserves from these other countries, right, stack up, even in China. And now gold's on a interesting run. And by the way, so is silver, right?
That's right.
Just went over 40.
Through 40, yeah.
Yeah. So are the first indicator of people trying to get out of U.S. dollars?
To some extent, yes. And 2010 was an inflection point. So if go all the way back to 1970, the United States had 9,000 tons of gold. We go all the way back to 1950. We had 20,000 tons of gold. We had almost all the above ground official gold in the world. By 1970, we were down to 9,000 tons. Where did those 11,000 tons go? Well, 2,500 to France, 2,500 to Italy, 600 to Japan, 700 or 800 to the UK. And those our trading partners ran surpluses. They took the dollars and bought gold. We shipped the gold, and they put it in their reserves, and they still have it. Germany was over 3,000 metric tons. But by the early 70s, there was a run on Fort Knox. The French actually sent a Navy vessel to New York to pick up their gold and take it back. They wanted, a naval escort to take the physical gold back to Paris. So that's why Nixon closed the gold window with our trading partners. It was meant to be temporary. He said temporary. You can find that speech on YouTube. He said, we're temporarily closing the convertibility of foreign reserves into gold. And what they wanted, and I spoke to two of the people who were at Camp David that weekend. Ken Dam was later dean of the University of Chicago Law School, and Paul Volcker, who became head of the Fed, but he was deputy Treasury Secretary at the time, so that's why he was there. But two of the people that I spoke to, both of them, they said, yeah, we thought it was temporary. We were going to have another monetary conference. We were going to devalue the dollar against gold, against other currencies, and get back to the Bretton Woods system. Well, they did have the monetary conference, Smithsonian Institution, December 1971. They did devalue the dollar or gold, a dollar against gold, from $35 an ounce to $38 an ounce, later $42. They did devalue the U.S. dollar against the other major currencies, Japanese yen, the Deutschmark at the time. There was no euro, about 12 to 16%, depending on the counterparty. But they never got back to the gold standard. They did all the stuff they said they were going to do. But what happened was, in the meantime, Germany was so sick of defending the dollar that they just went to floating exchange rates. They said, this is what the market decided, and we've never looked back. We still have floating exchange rates to this day. But from then on, central banks were net sellers of gold. The U.S. sold another 1,000 tons in the 70s. We went from 9,000 to 8,000, 8133 to be exact. In the late, and then we stopped selling gold. There's a reason for that. We don't have time to do it today, but maybe on some other podcast, I explain why they just stopped selling gold at that exact number, 8133. But we got everyone else to do our dirty work. So the IMF sold 1,000 tons. The UK sold half their gold in 1999 at $250 an ounce, by the way. That was the bottom. That was like the 20-year bottom. Gordon Brown was the Chancellor of the Exchequer at the time. They called it Brown's bottom because he managed to hit the low tick. Switzerland sold 1,000 tons in the early 2000s, and then the Swiss were up in arms. They had a referendum, don't sell any more gold. The IMF sold another 400 tons around 2010, and that was it. They stopped selling, and then they became net buyers. The buyers were not the same as the sellers. They were still central banks, but it was China, Russia, Turkey, Iran, even though Iran's non-transparent, Kazakhstan, Mexico, Vietnam has bought a lot of gold, etc. So ever since 2010, central banks have been net buyers of gold. It has caused the price to go up somewhat. It's not the only factor, but the thing I like about it from an investment perspective, it's what I call an asymmetric trade, meaning you got a floor. Because central banks don't, they don't go wild. They don't want to disrupt the market. They'll call the dealers, the big banks. They'll put in standing orders, buy 10 tons a month, do it on, kind of steady Eddie, don't spook the market, etc. And they're smart. They'll buy a dip. So that kind of puts a floor under things. So when you own gold, you have limited downside, no guarantees, but you have limited downside because the central banks put a floor, but unlimited upside because it's going to keep going up, which I fully expect. And so that central bank buying is a driver. Supply and demand, good old-fashioned supply and demand. Supply has been flattish around 4,000 tons globally for the last 6 years, up and down a little bit, but pretty constant. But demand is going up for the reasons we just mentioned. So when you have flat supply and rising demand, that's a recipe for higher prices. And the third thing is we are nowhere near the retail frenzy stage that we saw in January 1980. We're not there. We got the factors we just mentioned, fear of weaponization of the dollar, central bank net buying, flat supply, increasing demand. Those are all factors driving it up. There's a psychological phenomenon called anchoring, and people anchor on, let's say, $1,000 increase in the price of gold. So gold goes from $2,000 an ounce to $3,000 an ounce. That's a 50% gain, $1,000 an ounce. If you own, 50 ounces, you just made $50,000. But then it goes from 2,000, 3,000 is a 50% gain. But then it goes from 3,000 to 4,000, which is doing right now. That's another $1,000 gain. You made the same 50,000 on your 50 ounces, but it's only a 33% increase. Then it goes from 4,000 to 5,000, same $1,000 gain, but that's only a 25% increase. When you go from 9,000 to 10,000, that's only an 11% increase. That's like a good month. It's not like some phenomenal thing. So my point is, people are saying, hey, $1,000, $1,000 of making all this money, and you are, but each $1,000 is easier than the one before because you're working off a higher base and it's a smaller percentage gain. And that's when the everyday retail investor wakes up and says, holy smokes, gold's 8,000, 9,000, 10,000, here you go. And then it could very easily get to 20,000, but that's the frenzy stage. But it gets easier because it's a smaller percentage and therefore easier to do.
Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.
So let's change gears a little bit and go into the housing market, right? So right now, housing affordability is at an all-time high. Mm-hmm. Rates are going to be going down, we think, next year.
Mm-hmm. Yep.
How do you think that impacts the housing market, or does it impact it at all, in your opinion?
Well, historically, it absolutely did. And you put your finger on it, affordability. People, consumers buying residential housing. I'm not talking about investors in big tracts or commercial real estate. There's a little different. But someone getting a mortgage and buying a house, they're very focused on the monthly payment. I mean, yeah, they care about what the house costs and they care about good neighborhood and is it going to go up. Those are all factors, but they're very focused on that monthly payment because they have a budget and it can't be more than a certain amount because I can't afford gasoline or food. So when interest rates come down on a certain mortgage, either the monthly payment comes down or for the same monthly payment, I can get a bigger mortgage and the bank will lend that to you. So that generally does stimulate the housing market and create demand for, as you suggest. The problem is that there are some weird things going on in the housing market that, you've been in it for a long time that we haven't seen before, which are these very large institutional investors buying up houses, not just developers putting in, 500 units, but BlackRock and others. I'm not picking on BlackRock, but they are a leader in this, buying up 100,000 units and going with no desire to sell those units. They just want to rent them out. And when you do that, you're basically taking real estate and treating it like a bond. It's like I invest a certain amount, I have a certain cash flow. I'm going to keep the cash flow generating. Well, that's what a bond is. It just keeps paying you interest, or, stock. It'll pay you dividends. Well, once you do that, you're taking huge amounts of housing off the market. They're still there. People are living in them. They're paying rent, but they're not for sale. And so you would say, yeah, do lower interest rates make housing more affordable because of the monthly payment? Yes. But housing can become less affordable because there's no supply. There might be physical supply, but it's not for sale. You have to be a tenant. Is that, some kind of 21st century debt slavery, like student loans? Maybe, but my point is that's a new factor that is causing housing prices to go up, even in a world where interest rates are coming down.